So we will move on to the next concept called your chain holding. So we have understood how the consolidation is going to work. So consolidation adjustments and all, we are very clear now. So before we proceed, we will understand the concept behind the chain holdings. See what happens in chain holdings. It is like you are holding somebody through some other subsidiary. It is an indirect holding. Now chain holding is the one where the parent is controlling indirectly. So how this indirect thing works? Like parent has got 75% stake of subsidiary 1. Now because of this, you get the control over subsidiary 1 because you will get the ability to appoint the board of directors. Now this subsidiary 1 invest its money, okay, understand that, from the parent. Actually human beings are different here. Who holds the parent? From the parent's balance sheet, cash goes into this subsidiary's owners. So in the share certificate, there are two people now. 75% is parent and NCA is 25%. Now from their balance sheet, they make the payment to the subsidiary whose owner, and in their balance sheet also their share certificate S1 is going to come. Now since subsidiary 2 you are holding 80%, who controls subsidiary 2? S1. Who controls S1? Parent. See through this, see just with the simple majority, maybe you are holding 51% here, 51% here. With this simple majority, you will be able to control another entity. So maybe you are directly holding some portion also into this entity. You have seen that associate somebody was holding. What is your effective interest? Is whatever you directly hold plus whatever you hold through chain. That means 75% of 80 is what you are holding. See, there can be two ways of consolidation. See, ultimately, who has to prepare a consolidated financial statement now? Which parent? There are two parents now. There are two parents now. So this person has to prepare CFS. This person also has to prepare CFS. Now, how this parent can prepare CFS? There are two ways you can do it. One, take the CFS of, take your SFS plus take the CFS of S1. Finish. You prepare your CFS. Because already all intercompany eliminations, everything adjustment would have got settled. Alternatively, do one thing. Take SFS of 1, take SFS of 2, take your SFS and start consolidating. Which method generally they do? They go for the second method. Why? Because generally intermediary subsidiary would have been exempted. It's an effort, no, unnecessarily preparing consolidation for whose sake. That's why intermediate parents generally don't prepare the CFS. They would have been exempted. The parent would have told, don't prepare, I will prepare at the end. So you have to take SFS of those two people. But when you talk about the parent, what is your interest? It is not 80%. If you are holding 100% here, then it is 100% of 80%. But it is 75% of 80%. So that way we have to see. You will be able to control your effective interest of parent in subsidiary maybe 40%. Or say for example, if I have to tell you one example, in S1 you hold 51%, say 60%. S1 is holding 60% in S2. How much parent will effectively hold? 60% of 60%. Oh, that means your effective interest is 36%. Are you controlling this subsidiary? That's the confusion. You still control, but your effective interest is 36%. What is the concept of control? Control over relevant activity. How? By appointing the board of directors. Who appoints the board of directors here? S1. Why? Because you hold 60%. Who appoints the board of directors here? Parent. Because you hold 60%. So indirectly your effective interest is 36% for accounting purpose. For accounting purpose it is 36%, but in reality you control that subsidiary. Understood this concept, no? So accounting is different. In reality, maybe I may be holding 40%, 40%. Am I controlling this subsidiary? What if I am Angel Limited? What is this is Little Angel? And what is this Pharma? You have done that case where we never hold directly to total together. Forget this chain. Together itself we will hold less than that. But still we will control because we are the majority among the minorities. So the analysis of the control is a totally different aspect. It has nothing to do with the accounting. It is the reality. It is the truth. You have to see in reality who is controlling. But when it comes to accounting, we have to go with certain numbers there. Legal percentage of what we are holding there. Have you understood this concept? Yes. So to consolidate the subsidiary's financial statement, you will have to ascertain your holding. How much is the parent's holding? Always direct holding plus chain holding. That's it. In chain holding, this is one extra working you have to do, which same like consolidation only. Then what is your NCI? NCI is always the balancing figure. And here we have got two NCIs. One direct NCI, but I need not give the breakup. Another is chain NCI. You remember that one problem we solved, we said 6% and 45%. In theory, we discussed one question. That is like, here, who is my direct NCI? See, if you hold 80, 20% is direct NCI. Who is my chain NCI? It is 80% of 25% is my chain NCI. Because my NCI in the first will hold the second, investment in the second. But problem is when I consolidate, I will consolidate 100% of the asset. Sorry, where the? This is you are there already. See, your S1 is not 100% holding, no. S1 is a 75% holding, 25% is already there in NCI. So when you invested 80%, in fact, you didn't invest 80%. 75% of this you invested, 25% of this your NCI is invested. Because from whose balance sheet money went? To the owners of S2. Parents only 10% went, no. From parents' balance sheet, only 10% of the cash went to this owner. Who paid balance 80%? S1's balance sheet paid. But when the S1's balance sheet paid, parent didn't have 100% of S1. Parent had 80% only. So when investment of 80% was done in S2, in fact, two people made a joint investment. One 75% of that 80% you did, 25% of 80% that NCI did. Are you very clear about the structure? You are able to see that what I am explaining? No, some element of doubt is there. S2. Yeah, yes. So if I go here, so your effective interest is how much? 75% of 80%. So in total, in this subsidiary, how much you hold, parent will hold? You say, sir, directly you are holding 10%, there is no share to anyone. But in this 80%, I have to give 25% share to somebody. So my effective interest is only 60. So 70% parent will hold. So if in this subsidiary, if the 70% is held by parent, who is holding balance? NCI, how much? 30%. But you say, sir, NCI is only 20%, no? Who is this balance 10? It is 25% of 80 is that balance 10. That is this direct investment. If this investment was not there, your parents' interest will be 60%. So NCI will become 40. What is the breakup of 40? 20 direct, 20 chain. Okay, let's do one thing. What is 25% of 80? Sorry? It is 20. That means if you are holding 1 minute. Huh? See, if you are holding directly 10%, okay, chain holding 60%, 75% of it is correct, no? 75 into 0.8, 60%. So you have got NCI balance 30%. Out of 30%, straight away 20% is coming from this direct NCIs only. But in this 20, 10 is you, no? So how much is the pure NCI of S2? See, okay, how many shareholders are there for S2? If I have to tell you the shareholders of parent, there are 3 shareholders. One is S1 holding 80%, parent holding 10%, NCI holding 10%. Agreed? So in this, if I say 70%, how did you get 70%? Because when you say S1 is holding, in S1, how much parent is holding? Because there are again 2 breakup, no? Because S1 means parent and NCI. In this, 60% is you, 20% is them. Agreed? So now, if I have to give the breakup, see how much, where all places P is going to come? P will come here with 10%, P will come here with 60%. So in this, 70% is directly or indirectly held by P. So if the 70% is held by B, 30% should be NCI. Now where all we will have NCI? I will have NCI here. This is called a direct NCI, 10%, and NCI here, 20%. Perfect. Got the full breakup of it. Yes, you need not do. You have to just do one working note. This working note you have to prepare, and NCI is the balancing figure. Now, all the consolidation procedures will be same except one adjustment. Otherwise, it's the same. I'm going to teach you only one problem. The subsidiary 1 NCI share, that is 25% of the investment in subsidiary 1 into subsidiary 2 will be eliminated, and the same is deducted from NCI subsidiary 1 NCI balance. Don't, you will not be able to understand now with this. When solving the problem, I will teach you. That's the only one. Primarily 2. One working note you have to prepare for the stake. Second, you have to do this adjustment. Multiple layers we already discussed. You cannot have more than 2 layers. First level, if it is a wholly 100%, then you can have 2 more subsidiary. Then you have to stop. Otherwise, you have to stop with the 2 layers, because see, problem is if you have got S3 here, how do you do consolidation? How do you take the indirect percentage, effective percentage? It's very difficult. I try to look that combination. That's why government has stopped it. Legally, you cannot have. You can have third subsidiary one below the other only if the first subsidiary is 100%. In that case, effective interest calculation is easy. But horizontally, you can have 200, 300 subsidiaries. But one below the other, you cannot have more than 2 subsidiaries in India. That depends. It need not be. It can be anything. But if you want to have here 3 subsidiaries below you, first subsidiary should be 100%. Otherwise, you can have only 2 subsidiaries below you. Yes, so now we will solve the problem. I hope the basic part is clear to you. So take out question number 29. Understand this question because it is the same question like previous question only. Prepare the CFS of group companies P and S. Their balance sheets have been given. Oh, they have given you individual SFS of P, S and SS. SS is subsidiary. So they have given you 32 lakh shares in S. That is your investment in S Limited. 24 lakh shares in SS, which is S Limited investment in SS Limited. So you have got the purchase consideration. And you are going to assume that these investments are shown at a cost. We will proceed further. Bills receivables are there, bills payable. We don't know anything here, anything, nothing. But when we see here, they have given me the bills payable breakup. The bills payable of S is pertaining to P Limited. That means that much of bills receivable must be coming from S. No, the 70 should get eliminated. Similarly, SS Limited, you have got a bills payable 30, they have got bills receivable 30. So entire 30 will get eliminated. They have given you at the end of the year balance sheet, not before acquisition. Now P holds how much? 80% in S, and S holds 75% in SS. That also we could have verified. How? See, you have got 400 number of shares, 10 per face value. Out of 40, 32 P is holding in S, 80%. Out of 32, 24 is S is holding in SS, which they have given here. See, from this only we can know what is my percentage of holding, even though they don't tell you in the examination. They may do that. The business, when you acquired on 30th September 2011, okay, when the balance sheet is given 31st March 2012, is the same like the DF Ramakrishna story, where middle of the year the acquisition happened. So the moment middle of the year acquisition happened, you get into pre-acquisition and post-acquisition reserve. If it is not at the middle, you don't have that problem. Straight away you will take from the closing balance sheet. The business activities are not seasonal. Why they said? Because the profit is equally distributed. 10 lakhs included in the inventory figure of S Limited is the inventory which have been purchased from SS at cost plus 25%. Okay, so this one intercompany transaction happened. At the end of the year, there is one unrealized profit sitting. Now, it is an upstream transaction or downstream transaction? It is an upstream transaction because you SS sold to S. Followed, no? Now, distribution needs to be done between parent and NCI, since it is an upstream unrealized profit elimination. Parent adopted a NCI to be valued at a fair value. Now, what is the fair value? Assume the market price of S and SS are the same respective to their face value. Good. Face value itself is the market value. On 1st of April, at the beginning of the year, they said the balance was 80-60. Just go back and see how much is your reserve balance. 180. Oh, there is a change in the reserve. That's why I told you format in the previous question, because the change in reserve is nothing but a profit. Retained earnings, definitely you need not look at the opening balance. Definitely there will be a change, but first you should check the reserve, whether the reserves were there at the beginning or it got changed. Now, exam, okay, that's it. In exam November 22, all are same except the figures are 3.5 times the above question. And one note is extra. S Limited purchased goods from SS Limited after acquiring shares of SS. That means this was already not a pre-existing relationship. It was an intercompany transaction post-acquisition, which we assumed here. Possible, it could have been done in June and it's still lying. And see one more thing, students. See, you get questions like this where the figures are 3.5 times, figures are double, that's fine. If at all in any question you get the same exact figure, no, it can be a trap in the examination. Don't feel happy. Be more careful in that particular question, because yesterday, again, that's why I tell you, please tell me what mistakes you did, I realized one more thing, that again 1% you take, no. See, this is our mind only fools us. That's why one day before examination, see, people will try to sell their ideas to you. It is very important. One day before is very important. Correct, no? This is what we hear everywhere. One day before, 1.5 day before examination, preparation is very important. Agreed? This is where everywhere we hear. But to tell you, 16 years back, I didn't have that 1.5 day. I also passed through the same journey, no, what you are passing through. At that time, how it was there, then how did we do it? That's why I'm not disputing that 1.5 day is not important. 1.5 days is important, but not that very important. Because if you see, again, in that 1.5 days, don't focus on numbers. Focus on the methodologies. Because I just realized when talking to you that 1.5 days, if you focus on the numbers, no, since you have already practiced so many times, you will remember the number. And this thing, what is called a trade, I have seen at the foundation level. I was sharing you. People just write the balance sheet totals. From where? God knows. In the individual figures are different. Balance sheet total is correct. Why? It is there in the book. Followed, no? So that's why 1.5 days before, you just look for the adjustments. Don't look into the numbers there, because numbers can fool you in the examination hall. And why? Because they design the questions like that. You have seen, no? For that one examination question, they gave you the DF related question numbers. Interchange the numbers. One place you got a capital reserve, same numbers, just 1 0 extra there. See, these are all the, see, we are into some other play area now. It's not our BCom or where. Institute very carefully, intelligently designs the question paper. It is not a random question paper coming there. They set the strategies, set a lot of traps there. Because our brand is what? Tough exam. That is our brand, no? I say brand, right? They want to maintain it. But it is not that we cannot handle it. We have to be careful. Okay? Anyhow, please share more. Oh, sorry. More of your mistakes with me. Maybe I'll get a better insight. Yes, since it's the chain holding, always you will start with the first working note 1, effective interest of P Limited, parent. First thing we will calculate the effective interest. So we have got two entities now, S and SS. What is P Limited direct in S? How much P Limited direct in S? 80%. Do you hold directly in SS? No. Otherwise you would have seen in the investment, no? On SFS of the parent. Now how much is P Limited chain holding? Do you have any chain holding in S? No. Do you have a chain holding in SS? Yes. How much? 80% of 75%, because S is having 75% in SS. Out of this, 80% you hold, which is 60%. So your total is 80 and 60%. If you are holding 80 and 60, how much is NCI in total? You don't need a breakup there. How much is the direct NCI and how much is my chain NCI? Not required. Simple balancing figure. 20% and 40% is your NCS. So this is my first step. Understood? Now tell me, students, what should I do next? Goodwill, simple. Now to calculate goodwill, I need a purchase consideration. Is it available? Yes. I need an NCI. Is it available? Is there any step acquisition? No. Chalo. Then I need a fair value of the net assets acquired. Do I have the fair value of the net assets acquired? Okay, first of all, when I need the fair value of the assets acquired? When did the acquisition happen? Acquisition happened on 30th September 2011. On this day, what is my fair value of the net assets acquired? Is there any fair valuation exercise done? No. That means my book value must be fair value, no? That's why I don't have that working where depreciation I will recalculate backward for the machinery, plant and building, land and building. That's what I am very happy here, because my fair value adjustments are not there on the date of acquisition. That means I need to just calculate the book value of the net assets. That itself is my fair value. Sorry? Depreciation will be charged. Yeah, that's why. But there is no additional depreciation on the fair value adjustment, no. So that's what I will tell you. Whenever I file this, that means that my fair value adjustments, that inventory unsold, creditor uploaded, depreciation on that, those things are not there yet. Because I have taken over at a book value only. Maybe in the examination, one adjustment they say the PP was fair valued by 10,000 more. Everything same. So now how to calculate the book value? What I need? Simple. I need equity share capital and the reserve. So I will, in your previous question, the first working note was that plant and machinery. What was your second working note? Pre and post acquisition profit, no? Yeah, we will do that as a working note number 2 here, because fair values are not there here. Sorry? Oh, yes. If it was a if it was pre-acquisition, then what would have happened? Then there would have been one intercompany adjustments at that time. There would have been a debtor one place, creditor one place. So in the purchase consideration what you paid, we would have assumed it is settled. Net assets will, see, your inventory will become my inventory, no? Or maybe fair value adjustment might have come. See, again, that I understood your question. What you are asking, what if if inventory was purchased in the month of July? See, now if it was purchased in the month of July and on the 30th September you acquire your subsidiary, you know that there is one inventory belonging to you sitting at a higher place there, that you have negotiated, no? Yeah. Again, how exactly it will go, you don't need to bother. That's not, no, that chances are very low. Two or three times this question has come. Those chances are very low, very remote. And even though it comes, okay, what you can do is you have to reduce it from the purchase consideration, because it's like a pre-existing relationship. That profit element should have been reduced. Anyway, but we don't have any such instance to show, no. I don't have. Others have to go and do R&D into the past examination question of ICI, whatever, and I have to search a question like that, what treatment they have given. That's why my experience says that I say don't test you like that. If they test you, they will test you in one question, so that to make you panic. Probably that may be in the compulsory question only. But don't worry, Baba, there are some 85 marks other questions are there, no? Okay. Working note 2, pre and post acquisition reserve. So we have got S and SS. Previously we had one column, this time we have got two columns. Is there any change in reserve? Yes, how much for S Limited? What was the closing reserve? 100. What is the opening reserve? 80. So 100 minus 80, 20, and for SS 80 minus 60. Beautiful numbers. Now, is there any change in retained earnings? What is closing retained earnings? 50 minus 20, 30. For SS 60 minus 30. Again, beautiful number. Was there any dividend declared by somebody? They could have complicated more, no? Telling S Limited gave dividend to SS and S1 gave dividend to parent. Same treatment, but you see, it looks more complicated. That's why they have not given that. So if it was there, add dividend. Not there. So how much is my total profits during the year? 50-50. Out of this, you distribute like this: 25 pre, 25 post, 25 pre, 25 post. Nice numbers, no? Because it doesn't make any difference where you adjust what. Here in the study material. But in examination, it makes a difference. Yes, what should I do next? Fair value of the net assets. We'll follow the same methodology. Only one thing we skipped here. Working note 3, FVNA, fair value of net assets. So I have got S and SS. Equity share capital. How much? S Limited 400 and 320. How much is my opening balance of the reserve? You have got 80 and 60. Reserve was 80 and 60. That means on the day of acquisition only this, not on day of acquisition. 6 months before your acquisition only this much balance was there. Opening balance of reserve they only give, no? Arey Baba, previously we did know here. 80, 60. Where is this 80? This 80 and 60, opening balance. Now, what is your opening balance of retained earnings? 20, 30. That means on the day, 6 months before my acquisition date only this much balances were there, which was earned in the previous years. How much profits did you earn from 1st April to 30th September? Add 6-month profit, which will get added to the retained earning. 25, 25. So, you have got total fair value of the net assets 525 and 435. Yeah, 1st April 2011, 30th September 2011. So, these reserves were already because of the profits earned in the earlier years. That is, what is my reserve as on 30th September? That's what I'm asking. Definitely, this will be there as on 30th September also, plus whatever profits you have made. What if they would have told in the month of August some fire happened and some big this thing loss happened? It would have reduced your some profits during the year. No, here because any profits, losses, everything is sitting here. But understood, no? That this is for the profit for the entire year, which one previously. Out of that you said, look, my business is not seasonal. That's why we have taken 6 months profit is 25. If they say business is seasonal, first 6 months no profit, no sales only, second 6 months only you are done. That means that the pre-acquisition, post-acquisition doesn't come into picture. You say this is my total net reserve balance on that day because first 6 months you didn't make any profit. Real profits you made next 6 months of the after post-acquisition. I'm telling you just ideas so that you are conceptually very clear what we are doing here. Yes, after this straight away start with the goodwill. And this is one important step here because this step there is one difference. First is the one working on. So I have got S and SS. First is the purchase consideration. How much purchase consideration did you pay to S Limited owners? Who is preparing CFS? P. How much the P paid to the owners of S Limited? 340. How much P paid to the owners of SS? 280. Who paid? Okay, S means me only, no, Baba. It is my S is my son only, no. How, because who is preparing CFS? P is preparing CFS. How much P paid to the owners of SS? Because see, when you talk about SS, you have to ignore S. That's why step number 1 we calculated effective interest there. You paid how much? 280 in reality. Is that 280 did you pay? No. You paid how much? 80% of the 280. So you will write, you paid only 224, which is 80% of 280. This is one adjustment you need to do because you didn't pay 280. When 280 was paid to the owners of SS by S, in that 280 your share was only 80% and NCA share was 20%. Sorry, 60 is effective interest. When you take post-acquisition share of profits, you take that 60%. But when it comes to purchase consideration, how much did you pay? How much did you pay? See, post-acquisition profit, we calculate that first step, effective interest. But this is not your effective interest, See, from the balance sheet of S Limited, 280 went to the owners of SS. Now, who earns the profit at the end of the year? SS. So, you want to take your share of profit, take effective interest, 60%. But when the question comes, who paid the cash 280 to the owners? You say, I paid only 80% of it out of 280. Understand? Both are different. One place I will take, what is my effective interest? 60%, no? My effective interest is 60%. That effective interest is used to take my share of profit from the subsidiary, sub-subsidiary. But when you talk about the purchase consideration, it is not 60%, no, Baba. It is 80% of 280, because it is not the transaction at this level. It is the transaction at S level, not at SS level. Anything happening at SS level, you apply 60%. Anything happening at S level, you will apply 80%. Understood? Perfect? Clear? Okay. Then we have done, what is my NCI? Add NCI. See, this is only adjustment. Don't miss this adjustment. I told you, no, only one adjustment. This is that adjustment. And because of this, balance sheet is not going to tally now. That means this has got one second effect from that. And you have to tell me where it is. NCI, how much? They said 400 divided by 10 rupees. What did you get? Number of shares. Into, okay, we are talking about S Limited. NCI of S Limited. 400 into 10, we got number of shares. 10 rupees is the face value. No? Out of this, how much is the NCI percentage? 20%. Into, what is the market price of S Limited? 10. In exam, they may give you different market price. So first you need to find out the number of shares, check how much NCI is holding, and then multiply with the market price of S Limited. So you get 80. How much is my NCI here? So you have got 320 divided by 10. How much is the NCI in SS level? 40, no? See, I told you, anything happening at SS level, parent will take 40%. Anything happening at S level, it will take 80%. But this purchase consideration is one thing. Who invested with whom? S Limited invested. So I will take 40% into 10 rupees per share, 128. Yeah, please, if you are not clear, please discuss that. I want to be. Because see, how much is the total NCI at SS level? SS, no, because we are calculating NCI at SS. Out of 100, if 60% parent is holding, NCI will hold 40%, no? So I don't need to give a breakup there. How much NCI is direct NCI? How much NCI is chain NCI? That breakup is not required. Here in 128, there are two breakup actually. In NCI, SS Limited, 25% is the pure NCIs of SS, and the balance 15% is 80% of 20% of 75%. That means S Limited NCI in SS. 1 minute. So if I have got, let me check their holding. No, correct. This is correct. See, you have got how much NCI in SS? 40%. In 40, what is that? How did you get 40? Did we not calculate the effective interest first? Working note number 1. Balance is at the SS level. Because if you look at the working note number 1, we calculated that chain. Actually, there is actually two people here. 25% of this 40 are the pure NCI of SS. They are pure NCIs. And who is this balance 15%? They are SS Limited NCI in this, 75%. 25% of 75 is 15. But I don't need to give the breakup there. No. 340 because P is invested. No. When you talk about S, you don't do any adjustment. It is normal consolidation. Like what we have done, that Krishna, DF, Rama and all. It is only when it comes to investment in SS, this is what you do. You will take care. And one more thing I will tell you, one more simple thing. That's every place you have to consider NCI 640% loan. Every place. And you have to treat as if you forget about intermediate S there. You have to assume, see, this though you know. Do you have any problem with S limited? No, it's a normal DF type of consolidation. You have to treat even SS is also like a normal consolidation only, everywhere. Then you will ask me, sir, what is my stake? That is what we calculated in the first step, except one place. That is this purchase consideration. Now, that is parent share, because who is preparing CFS? Parent is preparing. So when parent is preparing, parent will treat S limited like a normal subsidiary. Parent will treat SS also like a normal subsidiary only, as if he only directly invested. How much? 60%. But when you talk about the investment done, no, this is one number which is taken at 80%, because you are not holding that. Just everything, it is just normal subsidiary. 60-40 only, everywhere, entire problem 60-40. As if parent only directly invested 40%. Every problem, every place, except purchase consideration where you have to take this 80% of this. This is only one place. Followed, no? Yes, you deduct the fair value of the net assets. So you get the bargain gain. Yeah, this is the confusing part. Huh? Once you cross this, once that sits in your mind, chain holding looks very simple. Even 20 minutes, you should be able to solve this consolidation problem. Have you understood the logic behind it, no? Why we are doing it like this? Why we are? Because ICA tells us, standards tells us. Why they tell? That is the logic behind it. They say that you cannot show something as your purchase consideration when in reality you didn't pay it. But what is your effective interest? Effective interest is 60% only for whatever at the NCA subsidiary level. Yes, next what I do after goodwill? Other equity. Okay, step 2, other equity. In other equity, I have got S, SS, P. This is NCI of S, NCI of SS. This is other equity or ConPL, you can call it by any name. Followed, no? Generally, we used to have 2 columns. But here we will have 3 columns because there are 2 NCIs, no? See, that's why they said more than 2 layers, you don't have any subsidiary. Imagine one more SSS is coming. Life would have become miserable. Okay, so what I start with? Opening balance of NCI. Normally what I start with? Opening balance of NCI. How much is my NCI of S? 80. NCI of SS? 128. Then opening balance of P limited reserve. Now let me focus on the P limited balance sheet. How much? I will add both. Opening reserve plus retained earnings. I can call it 180. This is my working. Because when it comes to presentation, I will have 3 columns in other equity called retained earnings reserves. So this 180 is because of retained earnings and the reserves of P limited. Sorry? 160 I will show profit for the year. Because P Limited, I don't know. No, they didn't give me the breakup. Profit for the year of P Limited, 160, because I don't know. At least reserves, I can assume it is opening balance. Retained earnings, definitely I will assume to be the profit for the year. Their share I will not take. Okay. Is there any other adjustment related to P Limited, given dividend to their shareholders and all? No. So I'll go to the share of S Limited profit. At the end of the year, you go to the closing balance sheet, go to the other equity of the parent, and take whatever other equity is there, dump it here. I just give the breakup. If you don't want, you club both 180 plus 160. I am okay with that. But when it comes to presentation, you will have some problem. Like, what you can always say that this is opening, you can always assume, no? Yeah, see, if you see the question, only for S Limited and SS Limited they give the opening balance. Did they give for P? Then you assume no. If you don't want profit for the year, you assume 180 plus 160 is my opening reserve. Who stops you? Question is silent. See, since the question is silent, since the P Limited closing balance sheet is showing other equity of 180 plus 160, you want to show the way you want, you can show it, because the question is very silent. Otherwise, they should have given you at the bottom that along with asset and SS, this was the opening balance of reserve of P also. So you are okay. I am not very particular about it. Clear, no? It doesn't matter, no? That's what I told. For P Limited, it doesn't matter. It's a P, right? It's a parent. Just take the balance sheet, dump it. That's why in my 4-step tallied position, first step I showed you, take the P's balance sheet. Logic is P Limited, I will never fair value. That time also I will find the book value. This time also I will take the book value. All the reserves I will maintain. All the equity capital I maintain. Then as good as take at any point of time, take their closing balance sheet. Okay, how much is my share of S Limited? How much profit did S Limited earn post acquisition? 25. How much is O's share? 20. 80-20, no? In S Limited, 5 is earned by the NCI of S Limited, which is 20%. And here NCI is 40%. So when the S Limited earned a profit of 25, 80% will go to P, 20% go to. Now share of SS Limited profit, how much? How much SS Limited earned? 25. How much P will get in that? 60%, 15. That's what I told you. Only every place you have to treat SS like your normal subsidiary only. That's where we have to calculate the effective interest. And the balance will go to 10 to the NCI of SS, which has got 2 more breakup, but not required to give that breakup, which is 15 plus 25. Did this SS Limited or S Limited declared any dividend? No, just leave it. Otherwise, you would have come one more dividend paid and you would have added there previously. Chalo, let us go to the fair value adjustments, consolidation adjustment. Is there any fair value adjustments? No, because you took over at the book value. Is there any impairment of the goodwill? Is there any interest on deferred consideration? Is there any upstream downstream transaction? Yes. What is that? Upstream transaction is there. Now, what is my URP? Can you tell me the amount of unrealized profits? Just look at the question. What does the question says? 10 lakhs included in the inventory figures, which is purchased at a cost plus 25. So 10 represents what? 125. 10 represents 125, no? What is 25? So you get 10 into 25 by 125. How much is the profit? 2 rupees is the profit. Out of 2 rupees, whom you have to add or deduct? minus, because it's an unrealized profit. From whose share? Where this profit is sitting? Upstream or downstream? Between who and whom? S, because, but when you talk about CFS level, S doesn't come into picture there. It is between P and SS. So how much out of rupees 2 P will take? 60%, 1.20. How much SS Limited NCA will take? Balance 0.80. Have you understood how the intercompany this thing URP elimination happens at a CFS level? Clear, no students? Is there anything else? Bargain gain? How can you leave it? Then you will get one balance sheet difference there. Bargain gain. Who is having bargain gain? S or SS? So what you will do? Which column you will show? So will I show here bargain gain how much? 105 and 83, correct? We have to write here, no? 188. Arre Baba, it is a parent's bargain gain, no? Or is it NCA's bargain gain? Parent's bargain gain. So you will consolidate both and you will show here how much? 105 plus 83. See, now we have done one adjustment. That purchase consideration, we showed only, instead of 280, we showed 224. When we showed 224, that means we showed less purchase consideration. Your goodwill will be less or more? Goodwill will be less. That means my asset side of the balance sheet is reduced. Balance sheet will not tally because it's one like day adjustment there. Because I am using a tallied balance sheet with doing certain adjustments. So should I not do one more adjustment, one same amount? What is the difference amount? 280 minus 224. I was supposed to show 280, but I showed 80% of 280, 224. 56 is my difference, no? Which is going to reduce my asset side of the balance sheet. Do one thing, reduce from the liability side of the balance sheet. You write S Limited, last one, NCI share of SS Limited. How much? 56. You have to reduce that from the NCI of SS. See, when you don't show investment of S Limited in SS to the extent of 20%, don't show their NCI also. If you tell that 100% of 80% is my investment, NCI also should be shown 100%. But when you have told, look sir, in that 280, 240 is only, 224 is only my investment. That means in your balance sheet, NCI investments you are not accounting, but you are eliminating it. That's why what you need to do on the liability side, you reduce that much balance of that particular NCI also. So effectively in the goodwill calculation, you reduce the NCI here. Means their investment also you will not show, their balance also you will not show. Because otherwise how my balance sheet will tally? Because I got a tallied balance sheet. In this tallied balance sheet, 280 is the investment figure. I should have eliminated full 280, but you eliminated how much? 224. No, actually you eliminate a full, but for goodwill calculation, 224 you take. The moment you take 224, your goodwill will be overstated or understated. So the moment you understate the goodwill, that much portion you need to understate the NCA also, because it is not your good. If you take 100%, no, you will recognize it as a goodwill, which you never paid, and you will inflate the balance sheet by NCI. That's why what standard says, when you have taken 80% of the purchase consideration, that exact difference you reduce from that particular NCA also. Now again, if you want to ask me, I will give you so much detailed explanation, which ultimately I know you will end up confused. Okay, see the explanations. So since you are curious to know, There is one reconciliation and all I have done. But why at this point of, what is the logic of reducing 56? You see, so many things I have to explain you. What happens first, how it goes, how it happens at the end. See, so many things, and ultimately it will go here. 167 rupees balance will remain. So, in short, what I can say, 20% of the investment is not mine, 80% of the investment is, okay, let me. See, followed, no? I just showed you now. So many workings are there, but not required. No? Why you want to break head? In simple, you understand one thing. 20% of the investment is not mine. My NCI made. So 20% of NCI is also not mine. So you reduce that NCI also, you reduce the investment also. Simple logic to understand and remember, rather than going through academically why that. If you are interested, I will share this working, but you have to spend time at home to understand it. But again, I feel this is not a priority right now. You understood the adjustment. This is one adjustment you have to do, other than everything is a normal adjustment. Okay? Perfect? Yes. So what's next? Consolidated balance sheet. Straight away start with the consolidated balance sheet. I have got only one heading here, CFS. So first thing, I start with non-current assets, PPE, in bracket, in pencil. How much is the PPE belonging to P? 320. S, SS. Okay, you can write two note here. You can say note number 1. Because after this, you are going to prepare notes to accounts. So write note number 1. So you are going to present it later. Okay, for time being, let us do this balance sheet like this. How much it comes to? 980. What is the next item? Current assets. Under that, inventory. Financial assets gets eliminated. But when you eliminate 100% of the investment, NCIs will shout. How can you eliminate 280? Did you invest 280? People will shout, no? That's why you negotiate with them and compromise and say, look, in my balance sheet, that I will eliminate 100%. At the same time, I will reduce your balance also by that much. Understood? Yes. Inventory, how much is P limited? 220. How much is S limited? 70. But is this 70 having URP? Should I not deduct 2? Where is the second leg? Since this is the post acquisition, second leg is in the other equity. Plus SS limited 50. Do you have any other adjustment relating to the inventory? Sorry? I didn't get it. Oh. The balances you are talking. 10 lakh rupees, no? We are going to assume that, 1 minute. 10 lakh, they must have settled it. Have they told you that debtor creditors are still lying? No. Bills receivable, bills. Maybe it is converted into a bills receivable, that 70 something they said, no, 70-30. It must be having this 10 also. Or they might have paid also. So our job is to eliminate your pay. Or if you assume, no sir, 10 lakh is also sitting, from inventories you will not deduct 10, no. Where the 10 you will deduct? From the debtors and creditors. Here from the inventory, only URP you are going to reduce. So how much? Note number 2? What is 125? S limited, that means this middle party. S limited inventory is standalone financial statement is 10 lakhs, but that is loaded with 2 rupees profit. the profit was, that means the cost of this inventory was 8 lakhs. So at a CFS level, I should show 8 lakhs. So 70 is the total inventory. Out of this, there is one inventory of 10 lakhs. So 75 to give breakup, I can say 60 plus 10. But this 10 is overstated by 2. So minus 2. Perfect. Yes, what is the next item? Bills, trade receivables. I say financial assets, trade receivable. How much is S limited? 260. Sorry, P limited 260 plus S limited 100, 220. Is there any intercompany adjustments? No. If you assume here, so 10 lakh is unsettled, minus 10 lakhs. But you have to give an assumption. Question says that only inventory is not sold to third party. Inventory is still lying, but the balance need not be lying. No? Understood, no, Kriti? Yeah, very good. See, very nice. I feel very good when you ask me questions, when you tell your mistakes. That discussion should happen now, because afterwards I don't want to solve these problems. All examination questions I want you to solve, realize your mistakes. But every single question like why 338, what we should have done this, that logic at this point of time, because we don't get this opportunity again. Offline you can discuss with me, but it's very good at this point of time when we are discussing this, we interact. It's nice, no? Because sometimes you ask me, I don't know which state of mind I will be there at that time. And when I will reply you, I may not reply you instantly, but here I don't have any choice. Okay, this is my note number 3, 580. What is next? Bills receivable, which is also a financial asset. How much is my P limited? 72. How much is my S limited? But in this 72, 70 is coming from the bills payable of S. It's an intercompany. You go to the bills payable section, minus 70. How much is of S limited? 30. But this is coming from SS, minus 30. So you have got note number 4, bills receivable only 2 rupees. CC is also one financial asset. P limited 228 plus S limited 40 plus 40. So note number 5, 308. Done. No? Asset side of the balance sheet is done. Notes you forget now. Notes you give later. See, understood? No? This is what I was trying to tell you. After your other equity, straight away jump into the balance sheet and do like this. See, this is how I presented. In the bracket, you write these numbers. So I'll go to the other equity. It's done. I'll go to the other equity now. Equity and liability under equity share capital. How much is my equity share capital? Note number, how many notes we finished? 5. Note number 6. 600. Only parent I should take, no? This is the most simple. Never ever, except reverse acquisition, there is no adjustment here. Only reverse acquisition I should think and sit and think there. Otherwise, absolutely no adjustment. Just take parent one. Other equity. Should you apply your mind now? What is other equity? No. Write note number 7 for presentation sake. Go to your step number 2. Take the balance of that. How much? How much? 561.80. Presentation wise, you do it later. You give reserve balance, retained earning balance, NCA balances, total. For this note number 7. NCI, that is also come note number 7, 166.20. Add both the people together, S1 and S2 NCIs. We move to the liability, current liability, financial liability, trade payable. In the bracket, you are going to write 470 plus 230 plus 180. Is there any adjustment? If your inventory adjustment of 10 lakh, you would have assumed minus 10, plus 10, minus 10. See, clean two adjustments you will give. You will give. Yes, so my liability is done. And this should take 20 minutes to you. That's it. Within first 20 minutes, you should arrive here. No, see, if you feel this question has come as it is, which already has come repeatedly, do it first, no? But which one? Not notes to accounts, sir. After this, leave some 2 or 3 pages, how much you want. Move to the next question. Because notes to accounts is not a big deal now. It's just an administrative job for you. This is the only thing you present now in the form of PSSS. Okay, maybe if you are interested, you can do it. I'll show you just. We need not do now, right now, because already we have done certain questions with the notes to account. See, notes to accounts will come like this. Whatever in the brackets you are given, see, you will present it like this. See, trade receivables, bills receivables, note number 4, cash and cash equivalent, other equity statement, where you take the opening balance of the reserve from here, consolidated profits you will take, NCS opening balance you will take from here, NCA on business combination, you take, because it was not opening balance. Huh? Why not opening balance? Because consolidation acquisition happened at the mid of the year. That's when you say opening balance on 1/4, you will not write NCA opening balance. That is our internal working. You call it NCA on business acquisition because it happened during mid of the year. This balance came only on the 1st October. Then bargain gain 188. So these 2-3 numbers will form your totals. Are you clear, students? Yes, Kriti. What is the doubt? This is coming from our step number 2 now. It's a presentation. It has nothing to do with your numbers are tallied, balance sheet is tallied there. Can I proceed further? Okay, no? 193 breakup, if you want you to go to other equity, remove 180 and remove 188 and just add everything. You get 198. If dividend was there, remove dividend also because dividend you would have presented separately. Then add everything. You get 193. This is what we have been doing. This is what I have been telling you from the beginning. Chalo, worst case, you give something what they are expecting. Only 1 mark will go. No? Trade payables done. Then you will give the note, assume that sale of goods is after acquisition of shares by P. But this assumption is not required because the question is already given. Else you should have given that note. Also assume that the profit has been earned consistently during the year. This assumption also they have given in the question. Otherwise you should give in the examination. Yes, take out question number 30. Okay, this is of LX, MX, NX. Please read it yourself and solve this. Yeah, students, there is one change. Okay, so actually is the question number 30. This is the number. You have to solve this particular question and then we will move to the previous question, whatever I showed previously. So you please pause the video and solve this question number 30, which came in November 18 exam. Yes, students, so we'll compare the answers for question number 30. Now, what did they ask you? They asked you to prepare the consolidated balance sheet of group of companies. Okay, by now we have already fairly established with one format. Our format is, we start with the working notes to calculate fair value of net assets. We will calculate the goodwill, other equities. If PP, building, land and all, they will give note number 1 PP because I cannot give separately. Straight away balance sheet, in the face I will write in the bracket, in the pencil. Then balance sheet tally, then notes to accounts. This is what we will do in every single question of consolidation. Now, equity share capital, okay, this is the catch here is generally they start with the asset. Here they started with the liability now. Okay, otherwise fine. 16 lakh, 12 lakh, we take the percentage 80%, 75%, and the holdings were acquired on 30th. That means both these holdings were acquired on 30th. Business activity is not seasonal. We need not give the note then. Assumption. They told you the balances of the reserves. 5 lakhs included in the inventory, which has been purchased from Sandhya at a cost plus 25. We know now what to do. NCA to be fair value, and here also they said the same face value is equal to market price. Chalo, no twist. Capital profit preferably to be adjusted against the cost of control. Okay, what is this capital profit preferably is to be adjusted against cost of control? If bargain gain is there, you adjust against the goodwill. But where is the goodwill here? That means in one place you get a bargain gain, another place you get a goodwill. They say consolidate and show net. Don't show goodwill on one side and bargain gain on the other side. But here I think you get both the places bargain gain only. So one more new learning for us. Sometimes they may not give you. Give one note. Now analysis of the profits and notes to accounts must be part of your answer. Okay, so analysis of the profits, that pre-acquisition, post-acquisition, that they are asking. And they are not looking for notes to accounts. Okay, and notes to accounts also they are looking for here. So I hope that we know now fairly. So we start with the interest, and your interest comes to 80-60, same as like your study material question. Yes, one mark gone, got no straight away. You move to the pre-acquisition, post-acquisition profits. You take the change in the reserve, change in the retained earnings, dividend here also they didn't give you. So in study material it is 25-25, you get 12.5. You cannot treat everything as a trap only, okay? Sometimes need not be, because ultimately ICA is unpredictable. When you think there is a trap, there is no trap. When you think it is not a trap, suddenly they will come from nowhere. That too at a critical adjustment point, which may have a cascading effect. So everyone got this number? Then I will move to the fair value of the net assets. I will take the share capital, all the reserve balances plus pre-acquisition profit, 262 and 217.5. I will go to the goodwill step now. Purchase consideration 170, and since it is a step chain holding, one adjustment I need to do here, then it comes to purchase consideration. Did you consider 112? Any mistakes done here? How did you get 105? I think you must have taken 140 into 60%. No, how did you get 105? Any students got any other number? Yeah, what is that? How did you get 105? I am very much eager and interested to know. So these are all 75% of 140. Understood why is not 75%? We have to say that, look, 75% is invested, but 100% of 75% is not the P Usha has invested. Usha has invested only 80% of 140. What you have taken, your investment in Nisha, Sandhya Limited. Understood? Followed, no? Yes, so NCA will be at a fair value only, so again, doesn't matter, but be careful, let us follow this format only. So it comes to same, and fair value of net assets we have done. In both the places we get the bargain gain only. If one place we would have got a goodwill, we would have adjusted and net figure would have shown. Because they only told us, adjust any gain with the goodwill, cost of control. You got these numbers? Yeah, you have that one adjustment for one. Next, other equity. You have got the opening balance of the NCI, but actually it is not an opening balance, mid of the year balance. Anyhow, doesn't matter, I told you, this step you will not get any marks. Opening balance of U limited reserves, U limited profit for the year. Instead, you could have clubbed these two things together. N limited profit 12.5, you break into 80-20, and Sandhya's profit you will break 60-40. Gain on the bargain purchase you will show it together. Unrealized on the upstream stock is 1 rupees, which you distribute 1:4. And the last is NCI balance, that 28 rupees which you reduce from the purchase consideration, that much you will reduce from the N limited NCIs. This is one adjustment. Same amount. How much did you get here? It's the same thing. Like here, we should have taken 140, but we took 112. So the difference between 140, that's why balance sheet will not tally by 28. So that much NCA portion I will reduce here. And now my balance sheet should tally, because all the two effects we have given. After this, we will straight away jump into consolidated balance sheet. Understood? No? Step 1, step 2 you did. The moment you do other equity, if at all PP has to be presented, that will give it as a note 1. Why? Provided in the PP you have got breakup, land and building, plant and machinery. If you take at the face of the balance sheet, it is only one PP. You write in the bracket 160 plus 180 plus 150. 490, did you get this number? Current assets will be 110, 35, that one unrealized profit plus 25, 169. Trade receivable of all the three parties, there is no intercompany adjustments. Bills receivable 36 and there is an intercompany 35, plus Sandhya's or Usha's 15 and minus 15, 1, and cash equivalent is 154. So total 1104. At the beginning, doesn't matter. Have you taken it under financial assets? Okay, enough, no problem. Then doesn't matter. Here you take interchange below, but if you show directly under current assets and below inventory, that is not acceptable. So I hope by now fairly you have understood about the Schedule 3 format also. Now I'll go to the equity share capital. I'll write now note number 6. We'll create one at opening balance plus reserve. Other equity, I'll write here note number 7, but I'll put my balance, working of my balance, 280. Because note number 7 is one presentation in a very odd manner. Worst case, leave. Don't expect only. If the evaluator gives marks, well and good. Others always say, assume that a 15-mark question, you are attempting in 14 marks only. NCI 83. Other liabilities also you'll write like this. So you get balance of 110. Perfect. Now you have done, no? Again, after some time you come back and looking at this number, you start preparing the notes. And then you erase that, whatever you have written in the pencil. You can take a risk, put it in, no problem. I don't mind. If I am an evaluator, why I should deduct your marks? That's the all, see, understood, no? Now this is all presentation part. From now onwards, it's just an administrative waste of time. This is just a presentations. So everywhere, like, and you have to give the notes. There is no assumption, only assumed to be goods to be sold after acquisition. Yes, students. So we'll move on to question number 31. Very beautiful conceptual question. So please pause the video and do this working and see how institute brings one small twist in the question. Yes, students. So we'll check the answers now. What was that difference here? They said rupees in lakhs, so we have to do in rupees in lakhs only. 79.6 shares. Okay, trade receivable, bills receivable, cash in bank, share capital, everything is same. LX holds 85% acquired on 1st April and MX is 60, 30th September. This is one conceptual difference. So for this, I don't need any pre and post acquisition. Whatever reserves were there at the beginning, that only I'll take. For the second one, I will take pre and post acquisition, and the 6 months profit I am going to add it. Then everything I think remains the same. They have given the reserve balance, parent adopt. Okay, NCA has not seasonal because I can distribute equally. Parent adopted on the fair value. So this time the market price of MXR, this time they have given you the fair values. Plus intercompany eliminations, that adjustment of the stock URP is not there. So this is a fairly simple question, right? Very quickly you can do as compared to the previous one, but with the concept. So you must be eager to know the answer, no? So first, did you get the effective interest? 85% and 51%. This is the crux, sir. If you miss here, then gone. This is a cascading problem. 15 and 49. Did you get this? Which is 85% of 60. Now we will move to the pre and post acquisition. See, change in the reserve 50 and change in the retained earnings 120. So total profits for the year is 170 to 20. How much is pre-acquisition profits? 0. So everything whatever you got 170 is a post-acquisition. This is one catch. Nice, no? See, I love this type of questions. This is somebody is testing us conceptually. Previous was a procedural question. Now we understood the difference between a procedure and a concept. And it is a mixture. I have never tried to actually, because I have to put more efforts to figure out in every examination how much is procedural, how much is conceptual. Leave it now. Let us focus on the procedural, try to get that first. And concepts also will. But concepts you try later, not initial. It needs a cool mind to apply the concepts there. In a hurry-burry, in a stressful situation, no, you don't know what you will do. Okay, any mistakes done here? What mistake? 50-50. 50-50. No problem. See, that's fine. I'm okay. But understood, no? Logic you understood, right? Yes. Why we are doing this working? What is the meaning of this format? Opening balance of the reserves, opening retained earnings, only the profit becomes 0 here. Okay, so you get only 6 months profit. So other equity on the acquisition or fair value of the net asset will be 3240, 2380. Did you get these numbers? Yeah, only thing you will get this number correctly, NX, MX is going to be missed. So part of the step marks you will lose. So how? I don't know what effect like that. Evaluator only can do that. Purchase consideration 2630. Did you write 1147.50? One more catch area. Yes, any mistakes here in 1147.50? Same mistake that you have taken, I think, whatever that, their investment portion. Anyhow, no problem. This should remain in your mind because we would have discussed this question before. You would have set it correct. Anyhow, no problem. Here, the difference is this. You have to multiply with the respective prices. Fair value of the net assets we have already calculated 260, 252.50. Yes, you will miss it here. Vishnu Priya. Correct, no? See, one effect will come here. Cascading, it will go somewhere other places. That's why we will keep our steps limited so that we have got a good hold over it. Statement of other equity, I start with opening balance 360,980, opening reserves 1150, profit of LX 1030, MX profit I will distribute into whatever that ratio 144.5 into 25.5. Did you get this? And NX profit I will distribute 56.1 and 53.90. Gain on bargain purchase, again I have got two gains, they didn't tell me, set off and all. So again there is no inventory elimination, but that 202.50 I have to reduce because this is what I reduced from the investments. And that too from the NCI of this MX. Doesn't matter even though you would have deducted somewhere else, but anywhere here doesn't matter because you see one final figure there. I told you this is our internal working. Any mistakes here? Now straight I will move to the consolidated balance sheet. PP closing balance is 4,500. Did you get? Current assets 3140. In bracket I have written the numbers there. Parent S and SS. Trade receivables straight away additions. Bills receivable 650, 60 minus 55 because 55 is my intercompany. And CC will be 1085, 90, 150. So you get balance sheet total 11,925. Then you move to equity share capital straight away. I'll take only parent. Other equity, you write note number 7, but take that our working balance. Why to break our head into what we are going to take? NCI, you are also going to take it from there. You add both the NCIs. Financial trade liabilities, you are going to add just 3 because there is no intercompany adjustments involved. Just 11,000, finish. Simple, no? Consolidation. Very simple actually. See, if you are interested, I will share one more question. In November 23, RTP1 question came. I didn't do this because this we have to do after Ind AS 36. Beautiful question. Very beautiful question. But I suggest please do it that. You understand in a detailed way impairment of the goodwill happening. So many things they have done that. Very nice question. Okay. With this, we are done with the chain holding. So next thing, we will move with the subsequent chain in NCI. See, we started our journey with 109. That 109 we increased and it became 28. 28 stake increased, it became 103. After 103, 110 came every year. So subsequent change means either I may increase my portion. I have taken 60%, got control. I will buy more, 20%. Or 60, out of 60%, 5% I sell without loss of control. That means any up and down happening without losing control is called change. That means I will continue 110 only, but my portion is going to change. From there, I will next, after point number 5, I am going to discuss about loss of control. That means you may you lose the control over it by selling something like your stake comes less than 50%. And this is called a discontinuation of your whatever 103. Then you may sell your associate also. Then you will come back, and this we discussed, loss of associate, control over associates. Then finally we will become 109, and one day done. This is like a kid here, this is like an old fellow and died one day. This is life cycle of your investment. And supporting this, you have got that BCG matrix: child, star, cash cow, dog. Why? Because it's an investment. No, it's a life cycle of one business. So somebody will start investing, keep and wait and watch, instantly increase their stake. One fine day when this business becomes cash cows, they get the control. When the business become old, they will come out of that business. One day they will finish. So in our accounting also we'll see one life cycle.